Good morning, everyone, and thank you for joining us for this August edition of our monthly client webinar series for 2020. Every year we take a hiatus in July from our webinar series and then crank it back up in August for the duration of the year. This webinar today is about health savings account, bank accounts, and Laura Bibb and Julie Blink. Laura's our senior compliance counsel and legal guru, and Julie's our vice president of administration, will be guiding us through this topic. In September, we're going to have an attendee choice webinar where anyone who's attended one or more sessions during 2020 will have a chance to either nominate or vote on a nominated topic that our client's compliance team will present in September. So more information to come on that. Hope that you can hear clearly. If you cannot, you may want to switch back between the phone or your computer speakers, one or the other. As always, we're at the mercy of the internet connection, which can sometimes be good and sometimes not be as good. But if you're listening through your computer speakers, make sure you have them turned up, and hopefully you'll be able to hear us clearly throughout the session. If you'd like to submit a question as we proceed, the best place to do that is in the question box on the control panel. You're also welcome to submit questions during or after the session to our compliance email box at compliance@probenefits.com. The session today is an update on health savings accounts, which continue to be the fastest growing benefit in America. Laura and Julie are going to provide a refresher on HSAs, what they are, how the bank account works, eligibility and contributions. And then after a short refresher, get into some key HSA topics that we know are of interest to employers and advisors, including interaction between health savings account, bank accounts, and flexible spending accounts, another tax benefit program that we work closely with employers on here at ProBenefits. Banking requirements, including identification verification, which is a formal federal legal requirement for HSA bank accounts and something employers and account holders need to be aware of. And then some other account management issues like how to manage an account, how to use investment options. So with that, I'll turn it over to Laura Bibb.
Thanks, Jason. And thank you all for joining us today. I know it's a busy time, and we appreciate you being with us. Just to provide a brief refresher on health savings accounts, as Jason mentioned, these are trust or custodial bank accounts. They're used to pay for eligible medical expenses. The great thing about HSAs is that the contribution, growth, and distributions for qualified medical expenses are all tax-free. So it's a great vehicle, and as Jason mentioned, a fast-growing benefit in the United States for employees to not only pay for current qualified medical expenses, but also to save and grow their funds for future expenses, perhaps after they retire. An HSA is an individual account, so it's a little bit different than some of the other accounts that we talk about frequently being employee benefits. It is an individual account, belongs to the participant, so it goes with the participant wherever they go. There's no COBRA feature. HSA is not subject to COBRA. The contributions are generally non-forfeitable, and we'll talk about that a little bit more as we go along. The employer doesn't have to participate, so this could be completely funded 100% by the employee, either pre-tax. Usually that's how employees will fund their HSAs, but it could also be on an after-tax basis solely by the employee. There are some compliance responsibilities, and we'll talk about those a little bit more as we go along in the presentation. So there are some eligibility requirements for health savings account. You do have to be eligible to participate. Eligibility is determined on a monthly basis, and the individual generally must be covered under what's defined in Section 223 of the IRS Code as a qualified high deductible health plan. And these plans have certain minimum deductibles and maximum out-of-pocket limits that are announced by the IRS each year. And for 2020, we've got the minimum deductibles listed here for self-only and family coverage. Good news, those amounts did not change for 2021, so those remain the same in order to establish your qualified high deductible health plan. There was a slight increase in the maximum out-of-pocket limits from 2020 to 2021 for those of you starting to look forward to 2021 and planning your benefits. We've listed the out-of-pocket maximums here for both 2020 and 2021. So you can see the slight increase there. One great feature of an HSA, as opposed to other cafeteria plan benefits, is that eligible individuals include owners. So you may have an owner who is not eligible to participate, for example, in a health FSA to have their medical expenses reimbursed, but they can participate in a health savings account. Finally, Medicare recipients are not eligible to contribute, and that's an individual who's actually enrolled in receiving Medicare benefits. There are some other types of disqualifying coverage. This includes first dollar coverage under those minimum deductibles on our prior screen. There is an exception if the coverage is considered permitted coverage or preventive care under the ACA. So some examples, general examples of what we see frequently disqualifying individuals from HSA eligibility are general purpose, health FSAs, certain HRAs, and then coverage under a non-high deductible health plan. So for instance, if they're covered under a plan of the spouse, their spouse that is not a qualified high deductible health plan, or a plan of their employer, if you offer two options and they're enrolled in the non-qualified high deductible health plan option, they would not be HSA eligible. And the key there is enrollment. So it's not eligibility for that non-qualified high deductible plan, it's actual enrollment. And one thing to note, if you're adding an HSA and you've previously had an FSA, there are certain features of FSAs that can affect HSA eligibility, the grace period and carryovers. So it's important that you look at those aspects. It's not an ending requirement, but you may need to do some pre-planning as you introduce the qualified high deductible health plan and the HSA option with your employees and participants to let them know steps they can take, such as spending down their funds in their FSA to make sure that they are HSA eligible. So since we talked about FSAs, let's talk briefly about the interaction between FSAs and HRAs. As I mentioned, the coverage under an health FSA does result in HSA eligibility for the entire plan year, and that's even after the balance is zero. So if you have a participant who's enrolled in an FSA and they spend all of their FSA dollars in the first 2 months of the plan year, they remain HSA ineligible for the remaining 10 months. If you have the situation of a participant who has an unused balance at the end of the plan year and the plan has a grace period, so they have an additional 2.5 months to incur claims, they will remain HSA ineligible until the first month after the grace period ends. So you can see where the planning comes into play, the communication comes into play with participants if you are adding an HSA option. These are things that they need to think about and communicate to employees so that they understand what they need to do in order to be HSA eligible, and if they are taking advantage of that grace period for their health FSA, when their HSA eligibility will begin. I want to note briefly that COVID guidance under Notice 2020-29 does provide some increased flexibility for cafeteria plans. This includes the ability to extend the claims incurred period So if you have questions about that, feel free to ask those in the question box. But if you have a plan and you're adding an HSA, that's something you'll want to consider, is that guidance and whether or not you will allow that for that FSA. And we also have done a webinar on these COVID changes, the Notice 2020-29 and other changes. So that might be a great reference too if you're looking for additional information. But the general rule of thumb is if there's a $0 balance at the end of the plan year in the health FSA, the participant will be HSA eligible on day one that you start that HSA plan. I get a lot of questions about runout. Runout does not affect HSA eligibility, so that is okay for the plan to have the runout period following the end of the health FSA plan year. Another feature of health FSAs that can affect HSA eligibility is a carryover. And this actually provides a longer period of HSA ineligibility. So if someone is enrolled in a health FSA and you are adding an HSA option, or they want to move from the health FSA to the HSA, they need to have a $0 balance at the end of the plan year. And if they have funds that carry over into a subsequent plan year, the participant will be ineligible for the HSA for that entire subsequent health FSA plan year. So again, planning and communication to participants is really key if you have a carryover. And again, COVID guidance does allow the extension of the claims incurred period, so that this may be an issue. If you've got a carryover and you plan to allow that, you may want to review those rules in Notice 2020-29, or reach out to us and we can help you with that. And then again, in our prior webinar, you can find more information. Employees can waive a carryover prior to the beginning of the next plan year. That allows them to preserve eligibility. There are also options to convert the carryover dollars to a limited purpose health FSA that would allow them to have HSA eligibility, because the limited purpose health FSA is compatible with an HSA. And we would caution you, there are some rules around mid-year changes. So if you're in a health FSA and move to a limited purpose health FSA, that there are some rules about HSA eligibility that we need to look at there. So HSA contributions are limited each year by the IRS. I've put the contribution limits here for both 2020 and 2021. Again, there's a slight increase for 2021, which is great news for individuals who are HSA participants and want to maximize their HSA dollars. Individuals who are 55 and older are allowed to make catch-up contributions of $1,000. This is in addition to these contribution limits. And that $1,000 catch-up contribution is the same for 2020 and 2021. That was not increased by the IRS. The contributions are determined monthly based on HSA eligibility. So usually we will see participants breaking that down on a monthly basis to determine what they can actually contribute for the year. There is an exception to that for a full contribution rule. If a participant is eligible on 12/1 and remains HSA eligible for the following 12 months, the following calendar year, they can actually contribute the full contribution limit for the year, even though they might not have been covered under the high deductible health plan for the entire year. So for example, if your HSA high deductible health plan starts on 10/1 and someone enrolls And as long as they are eligible on 12/1 of that year, they can make the full contribution for 2020, provided that they remain HSA eligible for all of 2021. And if they don't, there are some tax consequences there. But that is an exception to the monthly limit rule. With the monthly contribution rule and the annual limits, there are instances where there may be contribution errors. As I said previously, the general rule is that HSA contributions are non-forfeitable. Mistaken contributions can be corrected, meaning they can be taken back from the HSA in very limited situations. A great example of this is a mistaken initial eligibility. So if someone is mistakenly deemed to be HSA eligible and they actually are not HSA eligible, the IRS treats that as if they never established an HSA to begin with, and the mistaken contributions can be recouped. There are other instances where there are administrative errors. There has to be clear evidence, and these are limited and very fact specific. So if you think you've got a situation where you have an administrative error and want to know whether that can be corrected or whether the funds can be recouped from the HSA, reach out to us so that we can talk through that and help you with that situation and make sure that it's done in a compliant manner. If there are excess contributions made, for instance, if someone makes a mistake and contributes more, maybe they're contributing pre-tax and they put in some post-tax money too, or they make a contribution when they weren't eligible, those excess contributions are included in the participant's gross income and subject to a 6% excise tax. Those penalties can be avoided through the excess tax penalty can be avoided through a distribution of the excess funds, as long as that is done before the tax filing deadline for the particular year that we're dealing with. There are, I mentioned HSA compliance requirements, and these HSA reporting requirements are one of those compliance elements. They also are impacted when there are contribution errors. Form 5498 provides an accounting of the contributions for the year and the fair market value of the HSA. And if there is a corrected mistaken contribution or that is recouped, certainly that's going to reduce the value of the account, and that would be reflected on Form 5498 SA. Form 1099 SA is the form that comes from the trustee or the custodian of the account, and this form reports account distributions. It's actually filed with the IRS and provided to the participant, and any excess contributions that were distributed from the account to avoid the excess tax would be reflected on this form. And then finally, the W-2, if there are excess contributions, again, that is included in gross income, so that additional gross income will be reflected on the W-2 form that the participant receives from the employer. So in case you missed it, there's been a lot going on in 2020 in the benefits world, and some of these changes affect HSAs. One of the first changes, which is a great thing for HSA participants and other flexible benefit account participants, is that OTC drugs and medications can now be reimbursed tax-free without a prescription. And this is for reimbursement from January 1st, 2020 going forward. So if an individual has an HSA, they could go back and request reimbursements for over-the-counter drugs and medications expenses that they had back to January 1st. Second, their deadline to contribute to the 2019 HSA bank accounts was extended until July 15th, 2020. This is normally 4/15, the tax filing deadline, but because the IRS extended the tax filing deadline this year for individuals, we got some additional time to contribute to the HSA account. And then finally, HSA eligibility is not jeopardized by no cost or copays for COVID testing or telemedicine services received by HSA individuals. This was also welcome guidance back in the early spring when the IRS was looking at providing relief due to COVID. So next I want to talk to you about identity verification requirements. Remember, we've already talked about the fact that the HSA is a bank account. It is held by an FDIC-insured financial institution, and the Patriot Act is a federal law that applies to bank accounts and to financial institutions. If you've opened a bank account recently or any time in the past several years, you know that you've had to provide some identification documents in order to open that account. The Patriot Act requires all banks to implement what's referred to as a customer identification program, and this is to help ensure that we're fighting the funding of terrorism and money laundering. So anyone who's opening an HSA account must have their identity verified, similar as if you were going to your local bank and opening an account. When the HSA is opened, the individual opening the account is going to have to provide certain information. They're going to have to provide their name, residential address, date of birth, social security number, and tax ID number. And their identity is actually verified through a third-party database. There are instances where an individual may have a verification failure. For instance, this could be due to a mistake if their date of birth was mistyped or their name is misspelled. It could also be if their date of birth, name, or address do not match their social security number. So if someone has recently moved or changed their names and that doesn't match the social security records, then there could be identity verification failure, and it would be kicked out of the database as failing the verification process. So where an individual's identity cannot be verified through this database, we have to request additional information and documentation. And usually that's going to be a copy of the social security card or the driver's license. It may be both to make sure that we have the information so we can verify the individual's identity. If there is an identity verification failure, the HSA account is put on hold until there is successful verification. So what does that mean for you as the employer or advisor and for the employee? It means the good news is that you can continue to contribute. So the employer's contributions can still come in if an employer is making contributions to the HSA. If the employee is pre-taxing contributions or making after-tax contributions, they can go ahead and keep sending those, and they will sit in the account on hold. Unfortunately, what it also means is that the employee will not be able to request distributions from their HSA, and they will not be able to use their debit card. So once they have provided sufficient documentation so that their identity can be verified, this hold comes off and they will be able to fully utilize their HSA. If identity is not timely verified, the account is subject to closure and return of the funds contributed. And now Julie is going to go over some HSA management and account options for us with respect to the HSA account holders.
Thank you, Laura. Mainly what I wanted to do is talk a little bit about the HSA system for both the employer and the consumer. And the good news is there's two main words I want to use, and that is easy and simple. So on the employer side, I'll start there first. To add or to terminate a HSA participant is very easy in the system. What we feel like is the best feature for the employer is the way that the contribution funding to the HSA accounts can be managed by setting up a recurring contribution schedule. The majority of our clients are using that right now, and it is very successful. Super easy to use. Essentially, after a one-time setup by the employer, and certainly the account manager here can assist in that, all that has to be done after that is a management of adds or terms, or if anyone changes their HSA deduction amount on a certain payroll. The reporting that we supply to support that is accounting friendly, so there's a notification sent before the funding draft is pulled from the employer's account. So the employer on the banking side, on their banking statement side, knows what's happening, and it should match what was deducted from payroll. And then on the consumer side, the amount is posted to the consumer account within 48 business hours. So we find that really the best way and a very successful way to funding the accounts for employers to be able to fund to the consumer for each payroll. Switching over to the consumer experience, I want to go to the bullet 3. The account holders are prompted to accept the HSA agreements when logging on for the first time. The reason for this is because of administrative ease for both the consumer and the employer. We open the HSA accounts from the start so that funding can go into them. But until the consumer accepts the terms and conditions that you see on the screen right now, there is a hold on the account. So when I log in for the first time as a consumer, this is the first thing that comes up. I have to read and say that I agree to these 3 different acceptances right here. Very much like Laura, I'm going to piggyback a little bit on what you talked about on the IDV failures. Same kind of thing happens if I haven't accepted my terms and conditions. Contributions are going into my HSA account, but until I log in and accept the terms and conditions, I cannot use any of the distribution methods that we're going to talk about in just a moment. One other point of good news that makes the system easy and simple is after I've logged on for the first time and I've read and agreed to these terms and conditions that you see now, if I should have an IDV failure, I can take a picture through if I'm using the mobile app, or I can upload through the portal if I'm not, the documentation to support my IDV failure. So that's just another way that it makes it very easy for the consumer to take that picture of their driver's license or the Social Security card or whatever, and it's a secure way to send it to us if you're using the portal. So again, it falls under that easy and simple way. So after I have no IDV failures and I've accepted the terms and conditions, let's talk a minute about how I withdraw money from my HSA account. By far, there are 3 reimbursement methods, and I believe if we go to the next screen, there are 3 reimbursement methods that the HSA has. Absolutely, the most popular is the card. So when that HSA account is open for the consumer, automatically an HSA card is mailed to them. Probably the second most, and it's a long second place, would be an ACH reimbursement. I've added my banking information to my HSA account, and I go in to make a distribution, and my distribution will go directly to my bank account that I have on file. Or there is the last place, the check, and we have very few checks, but as a consumer, I can request a check be paid as my HSA reimbursement, and I also can request that my provider be paid by check. Again, most people, I would say 95% of them are not even getting to ACH or to check. They're using the card because of the ease of that. So one thing in comparing the HSA to the FSA, as we've done some on this webinar, is when I use my card for my HSA monies, there's no adjudication required. I'm not getting an email from ProBenefits asking for documentation to approve my distribution. I don't have a limit on when I have to spend my money by, and I just keep up with my receipts for my tax reporting purposes. So like I said, most of the time the HSA consumer is using the card for that distribution. But in the instance where I could not use my card, there are still services and providers that sometimes may not accept the card. If we go to the next screen is a screenshot of what the consumer experience is on the distribution portal. So you can see that I've logged in. I can see my account balance, and then right under that I can create a transaction, and I'm going to say that I want that to be from my HSA, and then depending on that method of reimbursement I want, at this point the card's not been used, so I'm either going to request ACH reimbursement or a check. And if I have added my bank account, as you see at the bottom as I'm prompted to do, then on the next screen you can see that my HSA transaction is going to my bank account. I have a credit union, a USA credit union account on file. So the screen, I don't have a screenshot of this, but if we were to hit next, the only other thing that I have to do is put in the amount that I want withdrawn from my HSA, and then there is a HSA disclaimer approval, pretty much where I say, yes, this is an eligible expense, and I am verifying that this amount I'm requesting is a qualified expense. There are a couple other categories that I can use to track expenses or the people that I'm spending them on, but the only thing I have to do after this screen is put in the amount and basically hit an I agree and submit. And the following day, my HSA transaction will be initiated to me. So one other note, you see at the top the contribution tab. I, as a consumer, can contribute to my HSA if I'm not doing that through payroll, or if I decide, at the end of the tax year, maybe I didn't put in as much as the limit, I could go in and true myself up that way, noting that would be post-tax instead of the pre-tax advantage of payroll, but it can be done. So I believe on the next screen, we start talking about investments. Certainly, HSAs are, their new name is the new retirement plan. It's a way that participants, consumers, can save for retirement. So the money goes in tax-free, grows tax-free, and distributed tax-free for eligible expenses. So the HSA can allow funds to grow, and investments can be made from those funds if the consumer chooses to do so. So the portal and the mobile app make that easy to manage for the consumer, and the consumer is completely driving that. So the next screen kind of talks about setting up the target cash balance, and the minimum for the HSA accounts is $2,000, but the consumer can drive. They can make that more if they would like. So what happens is when the consumer's contributions start going in over that targeted threshold, then it will automatically go into the investments, and the investments can be selected with help from the system, or you can select your own. So the participant can easily monitor the growth of that savings account as it's invested in the funds that they have selected. So this screen shows us kind of that investment setup, and it works, like I said, if I have contributed over my threshold, it's going to sweep in and take that excess and invest it. The same is true if for some reason my balance falls below the threshold, it would sweep the money back into my cash account so that I could, whatever I had requested for distribution could be used. So it's pretty much, you can see there, a simple yes/no question, and then in increments, I believe, of $2,000 of how to put my limit in. That wraps up, as I started out saying, simple and easy. That is truly how simple and easy it is for both the consumer and the employer in the system as far as the HSA experience that they have. I am going to hand back to Laura to kind of wrap us up this morning.
Thanks, Julie. And we've talked a lot today about HSAs, but I do want to mention that we do provide administrative services for FSAs, as we've talked about those as well, HRA, COBRA, POP, Transit. We also provide ERISA compliance services to assist employers and advisors. That includes Form 5500 preparation and WRAP SPD preparation service. We've got 3 benefits attorneys on staff and an experienced compliance team, so we're here to help you. Full focus on administration as well as strong focus on compliance. So any educational opportunities or tools that you need or would like to discuss, we are certainly available to do so.
With that, we will conclude the webinar today. Thank you for joining us. If you have any additional questions, feel free to submit through the question box, and we'll take a look at those in the next few minutes. Otherwise, feel free to share any questions or feedback to compliance@probenefits.com as listed on the screen. Thank you for joining us today. We wish you all the best for a good afternoon, and thanks for working with ProBenefits.